shit. I didn't know you were on the cover.
I'm on the cover of this book.
There you
We'll
go.
get to it. Duncan, how are you, my friend?
I'm good.
Yeah?
Yeah.
That's all you got for me?
I mean, yeah, I'm ready to go.
Nicole,
right.
say hi into the mic.
Yeah.
Hi, everybody.
All right. All right. Gang's all here. And is this your second appearance with us, Eric?
It is.
Yeah.
Okay.
You guys were generous enough to have me back.
Here's how lazy I was. I didn't write down the bio that I wanted to do for you, but we're going to let you fill that in. You are the host of one of the best podcasts in finance. It's called Trillions, put out by Bloomberg. How many years have you been doing that now?
4 or 5.
Okay. Same co-host, right?
Yeah, Joel Weber, the editor
Yeah.
of Business Week.
You guys do a great job with that. And what are you putting something out every week?
Every other week.
Okay. Do you ever take a break?
No.
Okay.
It's
exhausting, right?
Well, also it's sponsored, so they have a contract. You need to pump out 52 episodes. So the producer's hardcore about it.
So if you guys were like, we don't feel like it this week, they would just find 2 more people. Come in.
And occasionally I have an idea for one in a week between the 2 weeks, and they're like, no. So it's both. just stick to the 52.
No spontaneous pods. All right. Shout out to Trillions. And you pop up on Bloomberg bylines you're writing, and you're on Bloomberg TV once in a while.
Yeah, well, they reincarnated or resurrected a show that I co-hosted with Scarlet Fu called ETF IQ, which is on every.
Takes me right back to my childhood. They resurrected it. Did anyone know it left?
No.
Okay.
Yeah, you're right. It's true. Well, no. I will say
it's like we brought friends
No.
back.
Yeah. Wait.
All right.
Well, listen. It's important to me.
Shout out to Scarlet Fu.
Yeah. So there was a couple people who tweeted at me after the show was off for a couple weeks. They're like, "Wait, is your
What
show on?"
happened?
It was like 5 people.
You got canceled.
No, I said that all the half-an-hour shows on Bloomberg went dark because all the producers had to work from home and they could only do like the regular show, and the specialty shows were all shut down. So over the past couple months, they've been rebirthing all of these shows, and so now it's Matt Miller, Katie Greifeld, and myself doing a show on ETFs every Monday at 1 p.m.
Okay. We'll look for that. We'll look for that. How's Matt Miller doing?
He's good. He's really fun to work with. He's energetic and
Yeah.
good at improvising.
Is he bald?
Yeah.
He's a fellow bald.
Yeah.
Do you know that he had a late night show on Bloomberg?
Yeah, I remember it. He's
And
taught Grateful Dead lyrics and stuff.
Before I was doing CNBC, that was like one of the only shows that booked me. And it would be like Matt Miller, me, and like another guest. It could be anybody. It could be another Bloomberg reporter, or it could be like a chief strategist from Johnny Montgomery or something. And he was nuts.
Yeah.
Like he would spend like 15 minutes talking about motorcycles, and I'm like, "Are you sure this is on the air? Like people are going to watch this?"
Yeah, it was like 8 p.m. or something like that.
Well, that's
Yeah.
late night for.
Yeah, it's like
my
late night.
thing.
Yeah, honestly, I think the network needs a little of that. I think that show. I remember watching it, and just it was very laid back.
No, he was like Craig Kilborn.
Yeah,
He had a great personality. They should have made that. They should have kept that going.
they need more of that on
think
financial
so.
television. I think they need different kinds of programming that to just accent this sort of like I don't know, like Tesla fed or repeat.
Right. Because that never gets old. Today's show sponsored by Crane Shares. Do I have that
Yeah,
right?
that's
Okay,
right.
so we're going to talk about that a little bit. That's a big ETF story right now.
That might have been the story of 2021.
I think it's a big. I think it's a.
Top
Or
10.
one of. Top 10. Top 10.
All right, but you are an ETF.
That was a buy the dip.
No,
Buy the dip
They
with
kept
reckless.
buying it.
I know.
we've never seen anything like that.
It was like that scene from Wolf of Wall Street. We're not leaving.
Yeah.
They were not going to leave. They were
the
like, this is going to go up.
The fund fell 56% in 2021, and the flows
Took
just
in $8
kept-
billion.
There has never been
Set.
an ETF that's had price action versus inflows like that ever. I would
No,
say.
not
Can't
to
be.
not to that degree. And also, it's such a specific fund. China Internet. It's now the biggest China ETF.
Yeah.
Bigger than the broad ones.
Well, it makes sense that that's more popular than I don't know, China Utility Fund. Like I don't think anyone's waking up in the morning and saying they got to be into that.
Well, I'm saying it's bigger than like MSCI China ETF.
I do believe that would be true. So before we do anything, and we're going to get to this later, but I do want to mention that you are the author of a forthcoming book. For the people that turn the show off within like a few minutes, I just want to make sure we get to this. So this is called The Bogle Effect. And how long have you been working on this?
About 2.5 years. But there's some stuff in there that has just been research I've been building for 5-6 years.
Yeah. I think you're the right guy to have written this too, because you've got a front row seat for just the ETF industry exploding into trillions in assets and how influential Bogle's ethos, is that the right way to put it? Like his, I don't know, he wasn't a huge ETF fan even.
No.
But I think he had a big influence on the ETF industry regardless.
Yeah, one of the reasons that I wrote it is I started to make a lot of connections between what he did in the 70s, setting up a mutually owned fund company, and things that happen today that you don't really think are tied to him. For example, with ETFs, when the first ETF was going to be created by Nate Most and Steve Bloom of Amex, they went to Bogle and they said, why don't we trade the Vanguard 500? Bogle's like, get the hell out of here.
Get out of my
I hate
office."
trading.
Yeah.
But you're a nice guy. Here's some tips on the design. I think you could use some help on that. And they went up and sold it to State Street, and the rest is history. But when they priced it, the expense ratio, they priced it the same as the Vanguard 500 index fund, which was 20 basis points. There's no, it's my theory, and I feel pretty strong about this. No Vanguard, maybe that happens, but it's 80. And if it's 80, it could be used as a niche trading tool, but it does not sweep the country. So
You don't think it would have gotten down to being a cheap product eventually?
I don't think so.
There's no incentive for anyone to do it, right?
almost Wall Street asset managers, they're incentivized to try to get the most from the client. He's just an anomaly, and that's why now a lot of the industry is governed by Vanguard's mutual ownership
Hang on.
structure.
So the reason the ETF inherently began as a cheap way to get market exposure is because Bogle took a lunch with the guys that launched the first ETF?
Yeah, and the fact that he just had the Vanguard 500 index fund was launched. And by that point, it got whittled down to 20 basis points. I think it started at like 50, but that mutual ownership structure keeps lowering the fee every year. So it was at 20 when Nate Most launched his ETF. And to price it at 20, that's a good start for that industry because that sort of sets the tone that these things are supposed to be cheap. Had it been
But it
80
didn't have to be that way.
It didn't have to be that way because Nate Most and Steve Bloom, honestly,
Right. What if he pitched the idea to Ron Barron first? It probably wouldn't have been 20 basis points.
probably 150. And you know what? They would have gotten away with it because they wanted to have a trading tool. So, and you know from ETFs that are trading tools like the leverage ones, they're 95 basis points. Nobody cares because you trade it. Yeah. But by making it 20, it really, I think, opened the door and inspired when Barclays got ETFs that, hey, this could be a retail product. And so, again, that influence is major. So I premise that ETF industry would probably have 4 or 5% of the assets it has today if there was no Bogle and mutual ownership structure. So a lot of the book really comes back to the fact that indexing there is no such thing as passive. Like the S&P is run by a human committee. It's just large caps. Everything's active really. But what's good about indexing, why people love it, is because it's cheap. And so my premise in the book is that really it's low cost that is the thing, not necessarily indexing. It's just that happens to be indexing was one of the things that he made low cost.
Well, would you say low cost and low turnover?
Yes, you got it. And this brings up the main
the
theme.
committee is not picking new stocks every week. That's where it's different than an active
You're right.
fund.
You're right, but you are making a large cap bet. You have no small caps in there. You probably have a little tilt towards growth. But the S&P is great. Bogle liked it, although he preferred the total market at the end of the day. But I think the main theme of the book, and I almost called it this title, was addition by subtraction. I feel like that's generally his life's work, was taking what you were getting and then start to take stuff out of it. Let's take a little of the expense ratio. Let's take some trading out, turnover, brokers, this, that, and the other. And then you're left with basically the whole market with no friction.
You know what he wasn't really taking out of it, though? Or what Vanguard doesn't take out of it? The marketing spend. Like that part stays. It's just that there's no 12B1 fees. They're not like charging the shareholders to help them do more marketing, which is a very peculiar thing about the traditional 40 Act fund.
It is, and I think that was one of their big sins and why they got so disrupted. The 12B1 fee, the promise was, hey, we're going to take your money and market the fund.
And that will lower the cost.
And we'll get big, and then we'll lower your fee.
But they never did.
They never did. So I have a whole chapter basically looking at why active mutual funds were so disruptible. I think if they had passed on a little of the economies of scale, I don't think they would have been as easy to disrupt by Vanguard and index funds.
But there was just too much money.
I know.
And nobody does that voluntarily.
I admit in there, I'm like, look, if I had one of these companies, I would sponsor a sports stadium. I would hire new people. I'd get a cool new office. I'd buy a third home because I admit it, but that's why the book's on this guy. Yeah, he was weird.
So you, sir, are no Jack Bogle.
No, not at all. I'm weak, and let's just
establish that.
One more thing aside from just the index fund, which is obviously revolutionary, is like his whole ethos of stay the course.
Yeah. So there's a section in there about the 60s. He went into the 60s at Wellington. He kind of sold his soul out to this growth manager.
The go-go years.
The go-go years. And when the 60s crashed into the 70s, he had basically, and I think you had it in your Big Mistakes book, he had made Wellington, which was supposed to be prudent and balanced, pretty much an equity fund. And it went down the same as the market. It provided no protection like it did in the 29 crash. And I think really that tattooed in his brain forever. And at that point, he was like, I'm never going to sell donuts again. And so if you look at his speeches, whether it's in the 80s or the
funds
90s.
Or donuts?
Yeah, like
It's like a sugar high.
Sugar, yeah.
Yeah.
In the book, he compares the reason he went and merged with those growth managers was that he said, I felt like I was
had
selling
to.
bagels, but everybody wanted
Right.
donuts.
He felt he had to.
So I
By
have
the way,
to-
those investors were like the Jerry Sy was the Kathy Wood of his time.
Absolutely.
I was
Yeah,
gonna say,
there's a lot of parallels.
That cycle will never stop repeating itself in some way, shape, or form.
Yeah.
But that's what makes the Stay the Course also something I think he deserves credit for, because the speeches, there's a book called Character Counts, which he wrote, which is all the speeches in the 80s and 90s. It's kind of cool hearing him give a speech in like 86. And I'm thinking, well, I'm basically trying to collect a Don Mattingly rookie card. This is where the movies that are popular. And the speech sounds exactly
Yeah.
like he would say it in like 4 years ago.
So buy and hold comes from him.
Totally. And he just, I think the 60s were like, I'm never, ever going to take the bait again, no matter how tempting it is. We're just going to stick to this premise and lock into it. And that's hard to do given how seductive some of these cycles
But I
are.
like how he had to personally blow himself up doing it the wrong way to arrive at that message. And that's so important for investors to hear. Like, these people who are on the Mount Rushmore, they screwed things. I mean, Michael wrote a whole book about this. They screwed up, and that's why they figured out the right way to do this. So it's okay if you blow up your first or second portfolio iteration. Like, you can learn from your mistakes, and look who else had to. Pretty much everybody else who matters.
Also, a very underrated communicator. His books were good.
Yeah, I have a whole review of some of the books in the back, and I rank them. And as he got older, he got looser and a little more savage. But he was really a good writer.
The last few years where I don't give a Jack, and he
Fire
would,
and brimstone.
Like Vanguard would spend like $30 million promoting their emerging markets ETF, and Bogle would just be like, "Don't buy it.
Yeah, so it's funny you notice that, because
Don't buy emerging markets or ETFs for that matter." Next question.
I found that fascinating because the first time I ever interviewed him, the first time I walked in, he goes, "Did you see the FT article?" And it was about him trashing ETFs. And he goes, "That got me into a lot of trouble around here. They don't even talk to me anymore. They talk to the media." And I could tell there was this pretty big rift between him, and he's right on campus. They're like 100 yards away. And that was the first time I got exposed to this. But then as I started researching his books, talking to him, and re-listening to my interviews, I realized this guy trailblazed so many things: smart beta, quantitative investing, at least democratizing it, ETFs, international. Vanguard rules in all these areas, and he would just dump on this stuff like all the time. And he got to the point where he was like, anything that wasn't the total market index fund was garbage.
Yeah.
Dude, you know how funny that is? Like, conceptually, you picture like Ben and Jerry's, but like Jerry is sitting there like trashing ice cream, or anything that's not chocolate and vanilla.
Yeah.
And they have 88 flavors.
Cookie dough's garbage.
He's like, "What is this with Jimmy Fallon on the pint? What are we doing here? This garbage." Like, it's amazing that he would just be off the reservation all the time. But to Vanguard's credit, they were okay with it. What choice? Were they going to fire him? But to Vanguard's credit, they weathered that push and pull and let him continue to be vocal. And
Hey,
not that you could have stopped him.
before we get to our first official topic, I just saw an article. This is from Bloomberg. It was syndicated on Advisor Hub. Long-only mutual funds trailed their benchmarks on average by a full percentage point last month, the worst performance since 2002. And you've made this point that people like bash index funds or they're responsible. And Bogle makes this point over and over. Active managers set the benchmark, right? They are the ones that are determining how much money is going into Apple and Amazon and Facebook, and indexes are free riding on that. So how is it in a month, and I don't have the numbers in front of me, like where a lot of these tech stocks underperformed last month, that the active managers, that wasn't their time to shine?
Good question. My guess, I haven't looked at that, but my guess is that they tilted into some of those high growth FANG names a little too much, because sort of like the way a bond manager might tilt into high yield.
We're doing this later, and the answer is oil, not tech. But
They didn't have oil.
They didn't
right.
have oil?
They didn't have oil.
That's almost part of the-
out of
but
style.
oil's-
Out of
that's
style
almost the
with
other side of the
millennials.
coin.
But oil's so tiny that can't even move the benchmark.
Yeah, but when oil goes up 40% in a quarter, it does affect. It does affect your
My
performance.
guess is, let's say the S&P was 25% tech, 2% oil. what were they, like 0 and maybe 30?
Yeah.
Something like that. Yeah.
It does
That's
matter.
like ESG fund.
Yeah.
It does matter. We're going to do that later. This week, the big story was direct indexing at Fidelity and Schwab. And my take on this, look, they have to do it because this is where the puck is going.
Vanguard did it too.
Vanguard did it too. So like Vanguard, Fidelity, Schwab, God bless all three. We're clients of all of them. We're fans of all of them. But they are engaged in like this never-ending Me Too competition on a very big scale. If one of them does something, the other two have to have an answer.
Yeah.
And, you know, you never know which one will do it first. You just know the other two will be right behind.
I know we did direct indexing last time, and I think we kind of covered it all.
Let's run it back.
Yeah, we're just going to play that. You want to go smoke a cigarette or something?
No, I don't know if you want me to like pounce on the direct indexing thing or
Well, what do you-
because
all
I have
right.
another point about your big three and stuff.
Yeah.
Just a point in the book which I just want to highlight because I
It's
didn't
not
know.
going to stop at this book.
I
Go
know.
ahead.
Well, it speaks to the idea that all these firms are in competition now, and it's like who can be cheaper. But this was his dream scenario, and he had this quote in one of his books where I was like, oh, I can't believe someone would say this. He's like, I'll know that the Vanguard mission is complete when we start seeing our market share erode.
Yeah.
And I was
Oh,
like, that's
interesting.
crazy. I mean,
Interesting.
it's just think about that. Like,
Yeah.
who would ever say that?
Right.
But I think that's perfect scenario from his point of view. Now, whether Vanguard is more in the competitive, like, oh, we're going to get Schwab, I don't know. But I think Bogle wanted to see everything just go down.
You could throw BlackRock in there, actually. It's the four of them.
Totally.
All right, so here's what we got. Schwab launched direct indexing.
What are they calling it?
They're calling it
Personalized indexing.
personalized indexing, which is a little bit of an oxymoron. It's either personal or it's an index, but that is essentially what everybody's doing now. And we're proponents of direct indexing or custom indexing. But their version on their platform is going to be a minimum of $100,000. And most of them start at $250,000. So that's I guess an improvement in terms of how many people could use it. Fidelity's is a minimum of $5,000, which I'm not at all surprised by. What's your take on just the way they've entered this market? Are they too late? Is it just beginning? Do they have the right offering for the moment?
So you're going to mock me, but I have a chapter in the book. I know.
Unbelievable.
So
Good for you. I hope you sell a billion copies.
did I
I'm
just
not gonna
commit a
mock you.
foul?
No.
Sorry.
Dude, we're here to talk about the book.
So the chapter is called
The chapter
Fall,
in your book, The Bogle Effect?
Yeah, it's called The Fall and Rise of Active.
Okay.
So that legacy closet indexing active, I think, is slowly going to just go away.
Very
Or
slowly.
get small.
Very
Very slowly, but it will. There's just no flows there anymore. But different ways are spouting up. Direct indexing, to me, is a new face of active. Because when you do these picking and choosing, you're now active. You're just doing it on your own sort of premise, I guess.
It's
Or someone's-
algorithmically active.
Yes, but you're still...
And it's personal active.
Yeah, but you're still veering away from a benchmark,
Yeah.
and it charges a little more. It's like 40 basis points. The Fidelity and the Schwab, I think, are both 40.
The Bogle heads hate this for some reason. Why do they hate it?
I don't necessarily hate it. If you want that portfolio, fine. I think what they would say is, well, let's say you start being active, and then over 50 years, that 40 bips plus maybe some active mistakes you make by trailing the
Gives a
S&P
shit. Who gives a shit?
could add up to a few $100,000.
And what if you end up ahead?
Yeah, it's possible.
Right.
Yeah, no, I don't.
What if you like?
I
In
just
other
think
words,
it's a
what
new.
if you
I
have
just
a
think it's a
tilt?
new form of active, and I think Fidelity would much rather you do direct indexing than buy their zero fee index fund.
Obviously, costs matter, but what about if the fact that you get like personal satisfaction out of this and it's worth the 40 basis
Totally,
points
that's
to you?
worth something. And even in the Robinhood crowd, I have a little part in there about ROE, return on entertainment.
Yeah.
It's fine.
Yeah.
I'm not. I'm just trying to put. In the book, I have both sides. I have Nature AC saying this isn't great, and I have Michael Kitces who loves it. And I'm like, you be
somewhere
the
in the-
judge.
I guess-
What is Nate's argument against it? Because I
Just
have a
that-
lot of respect for his
Yeah,
point of
just
view.
that it tries to reverse a bunch of trends at once, and I kind of see that cheap, passive, and
So it's a little bit more expensive.
cheap,
It's a little more active,
passive, and simple.
Yeah.
and it's a little bit less.
But it doesn't
simple.
have to be that complicated. What if you just say, you know what? I really hate Wells Fargo, for example. I don't want to own Wells Fargo. I don't think that people are going to start trading their personal index.
Here's Schwab's quote. Each investor is different, and we are now able to leverage our significant scale, deep portfolio management expertise, and commitment to innovation to expand access to personalized solutions that will enable them to invest in ways that meet their distinct goals. That's the CEO of Schwab Asset Management, meaning the active component of it doesn't have to be about we think we're smarter than the market. there are people who want an index, but they have different goals than someone else who wants an index. So the way they personalize it might be to add more risk.
You can't
or
buy,
take less risk.
You also can't
Sure.
buy. You also can't buy the S&P 500 x Facebook.
True. And by the way, if you have a portfolio of 5 ETFs, that's a direct indexing in a way.
And also,
you
what about-
basically have 5 ETFs. Those are all active choices. So I think if you're a Bogle-esque Puritan and you're veering away from the total market, which they view as the best frictionless
oh,
way.
he would hate this shit.
Yeah, he hate it.
Yeah, he wouldn't. I don't think he'd like
He's
it.
rolling in his grave right now, just
Well,
hearing
that's
us talk
one,
about
one
it.
of many things. I mean,
What about- what-
By the way, we have a little part in there. I asked Jason
Well,
Zweig.
he-
I'm
wait, hold on.
Jason
And-
Zweig, what if he was alive for the Robin Hood thing? He was
Oh,
like, he's
my
like,
It would have killed him. It would have
yeah,
killed him.
That would've
people
killed
were
him
his
if he
head
didn't
would've
die
exploded.
already.
Yeah.
Oh my God.
What about taxless harvesting? We haven't spoken about. Like that's a thing that matters. That eats into the
Surely, and
costs.
Bogle heavy into taxes in his books. He brought that in a lot. He considered that something you really need to work. That's why he used that to weaponize against active. He thought they were not good with the taxes. But I think he might like that. I just think, again, Bogle I found over the course of the book, especially international, like everybody who, even his closest friends disagreed with him there. They liked international and ETFs. So he was just so pure that he was really a man alone in that everything outside of the direct and total market.
But he also was willing to make exceptions in his own life where it made sense.
Totally.
Oh, his son ran his hedge fund.
His son
Yeah.
ran a hedge fund and an active fund, and he invested in both. And he said, "Family's family."
Yeah.
So
Oh, he had a great line in his book. I remember quoting. I can't remember what he
life
said.
is messy. He basically
it
said.
was, yeah, it was based something like
Yeah.
that. Like sometimes there are more important things than just dollars and cents.
Yes.
Direct indexing 22% of the separately managed account industry's total assets, up or down. It's going way up.
Wait, direct indexing is SMA.
It's 22% of all SMA assets.
In other words, the rest is institutional.
no. The rest is like actively managed stock picking,
Oh, okay.
fundamental analysis.
Oh, I see.
Parametrics big.
Yeah, I mean,
362 billion in assets in direct indexing strategies. Projected 5-year growth rate of 12.4% in both ahead of both exchange traded funds. So this is going to outgrow ETFs, outgrow mutual funds. Obviously, this is Cerulli data. I think that 12.4% sounds low.
I think it sounds high. I see direct indexing carving out a niche, maybe 5-10% of the whole fund universe.
Because of how complex it is.
Yeah, just like go to a car dealership. How many people who buy a car at a Lexus dealership need some kind of customization? They're fine picking one of 4 cars. This is just generally how people shop.
So who is this for? Millionaires?
I think so.
And
people
then
who are rich and really hate taxes.
Right.
I think that's a great deal.
So
I
that's
think
a
the
wealth
Bogle-
management client.
Yeah, sure.
Okay.
Yeah, I mean, I think the people who might be against it would just say to themselves, why mess with success? You've got a 3 basis point total index fund. You can get all the bonds for 3. It's beautiful.
Okay.
Don't mess with it.
Vanguard.
That's sort of what I think the response.
Vanguard acquired a company called Just Invest, which was $1 billion in managed assets when they bought it. BlackRock bought Aperio.
Yeah.
They paid over $1 billion. That was a direct indexing company.
And
Sausalito.
didn't Morgan Stanley buy Parametric?
They did.
Yes. Fidelity.
By the way, Morgan Stanley getting into ETFs.
We're about to talk about that.
Okay, do you mean to stop?
Is it in the book?
Yeah, what page is it? One more thing on this. I love Fidelity. Fidelity, I love you. Fidfolios is DOA.
Yeah,
They should have
kind
called
of
me.
lame. I know.
What are they gonna? What are they?
Fidfolios.
You have an idea?
I could come up with 20 ideas, like literally standing on my head, that are better than Fidfolios. I feel like I don't know. I feel like they didn't really think that one all the way through.
I bet you they paid hundreds of thousands of dollars to a consultant. I'm
But
positive.
what's ironic is they might end up having the best product because Fidelity often has the best version because they're never the most expensive. They're never the cheapest. The shit that they make always works.
Yeah.
So they might actually have the best version with the worst name.
And Fidelity, even though
Are we sponsored by Fidelity anytime soon?
They're malleable though.
Okay.
They're malleable.
Nope, we're not.
They killed the Spartan name, right?
Yeah, that
Their
was
index
terrible,
funds.
too.
That was bad. That was confusing.
Shouldn't it have
They-
just been called Fidelios? Wouldn't that have worked
Like
better?
SpaghettiOs?
No, that's the
Fidelios.
password from Eyes Wide Shut.
Duncan.
Yeah, he loves that movie.
Yeah.
I do too.
Duncan, Fidelity
Underrated
just
Kubrick.
called. You're fired.
All right.
He went to
Fidelio.
the party.
So Morgan Stanley. So all right, fine. So there's an article over the weekend, a profile on their COO.
This is Barron's article. What's the guy's name? Let's just set this up right. This guy's killing it for them. Jed Finn, great name. How Morgan Stanley built an asset gathering machine. Garmhausen wrote this at Barron's. I thought it was really good. Okay, go ahead, Michael.
No, I was just toss it to you before we get into the story. What are they doing with ETFs? Because I saw you've been writing about them.
Yeah, so they were one of the last big holdouts. That said, they're one of the first big wirehouses to get in, which is interesting because they have $200 billion in other ETFs. So they could actually move some money over to their own in-house brands.
Oh, so meaning JP Morgan has their own ETFs for the
Yeah.
wealth management business. Goldman Sachs has ETFs
Yeah.
and the wealth management business.
Yes.
Morgan has a wealth management
Yes.
business, no ETFs. Until
Right,
now.
that's right. That's right. So we call it BYOA. We
Yes.
think there's a
Bring
big,
your own assets.
Yes. Well, why? It's better than pay the other guy, and it makes sense. It won't work for everything. We've seen that nobody, even if you're Morgan Stanley or JP Morgan, you're not going to move to their generic S&P.
Right.
That brand is you want the S&P. But like, I don't know, Developed Market International, they might move to the generic.
Short duration
Yeah,
bonds.
Yeah, fine.
I
Yeah.
actually think something like an ARC, Goldman Sachs has their own
They have that
innovation
index.
product.
They have that
Dude,
index.
You can replicate that in-house.
Non-profitable tech index is Goldman's.
I saw I wrote a whole note saying, you guys, why wouldn't you launch this
It's
at like
ARC.
20?
It's ARC.
You could Vanguard ARC at 20 bips. I do think Kathy's brand name would retain some of those assets, but this is not
for
a bad
now.
idea.
But if you're pushing Goldman clients into it,
Yeah.
that you can do that.
Apparently, the person I asked said something about, well, there's licensing with the name and the index.
Well, you know,
and
you
can't just-
also can't build an ETF on top of an index called not profitable tech.
Yeah, I say you can. Maybe Goldman thinks it's just too crazy
Or
sounding.
just change the name of the index.
In this day and age, that's actually exactly what you should do.
I
You
know.
should call it piece
Garbage.
of shit tech
Yeah.
stocks, and people will throw money in it as they create memes.
I agree.
When's the
It's-
levered version coming out?
Levered piece of shit tech companies. John, I'm sorry for all these bleepable events. My bad. I'm very caffeinated.
By the way, the Morgan Stanley, I also think that the CEO was on.
The Morgan Stanley.
Did I say the Morgan
Tell
Stanley?
us about the Morgan Stanley.
No, you know what's cool? Morgan Stanley. Drop
Yeah.
it though.
Go ahead. Tell us about it.
Okay, hold on. You just.
All right, keep thinking.
Hold on. Let me come back. Okay, here we are. Okay, so Morgan Stanley got their CEO was on Bloomberg TV like, I don't know, 8 months ago, saying we bought Eaton Vance, we bought
Gorman.
Parametric. This
Yeah.
is the way. And I thought, and my thought was, what they're trying to do is sort of bypass the ETF terradome. They're going to go right to direct indexing and hope they just don't have to deal with that market. The fact that they're jumping in, I think, is a sign that the parametric flows aren't that great. I cannot get the people over there to send me the numbers, but my guess is there are a couple billion tops, and ETFs just took in $1 trillion. So to your point, I think those two factors, they're like, yeah, maybe it might be the big thing in 10 years, but look at the numbers last year. We have to do something. That's my guess.
I don't. This is not a diss. I know a lot of great advisors at Morgan Stanley. I don't think the average Morgan Stanley FA has the sophistication to sit with a $2 million household and walk them through the nuances of direct indexing in a way that it would really be worth their time to even try. It's so much easier to just do what they've already been doing. So to that point, I really think that this is a killer product for RIAs. Not that RIAs are smarter. It's just more worth their time considering how much more they own that relationship relative to a bank owning a relationship and having a salaried employee.
It didn't happen overnight for us where we were like, all right, here's this new index product. Like, let's get it. It took us.
We had to learn how to talk about it, let alone teach the clients.
Like weeks and months easily.
Yeah, I mean, Michael Kitsis, who I interview for the book, is very bullish on this. But he, like I said, I thought his bullishness was from the advisor's point of view instead of the investor.
There's different levels of bullishness. You could be bullish on it being an amazing tool for advisors and not think it's going to take over the industry or the world or I think that's sort of where I am.
It's not going to take over the
That's
world.
where I am.
Yeah. So, okay, let's say 10 years from now, what if you have mutual funds, ETFs, and direct indexing all quote as a sort of pie chart? What market share do you think direct index would have relative to ETFs and mutual funds?
I just told you it's 22% of all SMAs. I would say it's like 40% of all SMAs, and that's a lot of money. That's a lot of money.
That's about, I think SMAs have what, 4 trillion? So we're talking about
Well, we're
1
saying
trillion?
it's $1 trillion.
So in 10 years,
1.5 trillion?
ETFs will pass mutual funds, correct?
I think so.
Yeah, so I
and
don't think this ever gets bigger than ETFs.
Yeah,
No.
ETFs
How?
are too simple. They're
Yeah.
too simple, and they work.
Yeah.
They work really well.
Yeah.
I think that if it's a fifth the size of ETFs, that would be big. That'd be huge.
Back
Yeah,
to,
so
ba-
and so that's how ESG and direct indexing are two things that we're not bearish on them per se. We're bearish versus the hype. You sometimes see someone come out and really say this is going to kill ET. I mean, or ESG.
I'm bearish on ESG ETFs.
Yeah, and they'll be like, "Oh, this is going to be 4 trillion." I'm like, "Whoa, whoa, whoa! Anything trying to dislodge 3 basis point total index,
Yeah.
I just can't. It might nip at the sides of that.
There's no reason for it to.
Hey, if you
It's
if
just
you
too hard to dislodge that.
if you back out the flows into BlackRock from their model portfolio, what are ETF ESG flows look like? Probably not that strong.
I think BlackRock. I mean, I got to say, we call that the BYOA. If you take BYOA out, I think that's 40% of all ESG ETF flows.
Yeah, I'd say easily.
And the biggest ETFs are all the BlackRock.
What's BYOA?
BlackRock
Bring your own assets.
BlackRock put their ESG fund into their model portfolios. I don't know if that's like. I don't know if I'm. I don't know
so
if I read
that,
that.
so that
Yeah,
counts
Yeah,
as inflows.
Yeah, they took
It was
they
huge.
replaced
Yeah.
IVV with it, ESGU. Now keep
ESGU?
in mind,
Yeah, okay.
ESGU is the S&P. If you look at
It
the
is. It's the
holdings,
same exact thing here. I'll show you.
It's got such a small active share. They couldn't do it if they went hardcore ESG.
Yes, but it
because-
makes me feel so much better.
right.
Right.
Yeah,
It's a
I get
feeling.
it.
ESG is
It's a
selling a
feeling
feeling.
thing.
Oh man, it's massive. So this that's 2020. So the only thing here, by the way, it was $1 billion. Now it's at 25. This is just model portfolios.
Probably. I mean, they get their salespeople
What
on
else
it.
could it be?
Well, I
1
have
to
to look at the
25.
holdings.
1 to 25 billion.
So they.
But I will say, once you put it in the model, it goes up to
you know what that's
7, 8
like?
billion. It seems like a popular ETF. So BYOA can actually kickstart some organic flows too, because assets are marketing.
But you know what that's like? That's like Netflix. They're like, oh, Sandra Bullock's new show where she's blindfolded the whole time is the biggest hit in the world. It's
Yeah.
like, yeah, you put it on the homepage.
Yeah.
Yeah.
You could make it the biggest show.
And by the way, look.
BlackRock could do that with any ETF
Well,
at any
This
time.
is SPY versus ESGU. Total
Yeah,
return
it's,
price.
it's the same thing.
Apple Music could decide who's the number one selling artist in the world
You're
today.
right. Gabe basically said BlackRock, they should teach this PR move in business schools because Larry Fink's out saying ESG is the future. This is great. And then when they do the conference calls and the quarterly calls, they brag about the assets. But I'm like, well, come on.
Kind of directed it.
Yes.
Good for them, though.
I know. I mean,
Yeah.
it's fair to call it out, but it's also fair to say, you know what? Like,
But that's their advice.
that totally.
Because
The other
they're an
thing I would
asset
say
manager.
To,
They're
to
get-
that point, it's not hurting anybody.
It's not hurting anybody. And it's cheap. It's only like 15
The
bits.
performance is exactly the same. So if you want to be ESG, who gives a shit? It's the same performance.
Well, here's what someone would say, and this is where they get dragged on Twitter, is you could get IVV for 3. So it's honestly 5 times the cost.
Whatever.
I know.
Yeah.
But now you're down to...
BlackRock's getting dragged on Twitter. They have
cares?
they have $14 trillion under management. How will they ever recover from that?
I think
I know, they got actually. Oh my God,
yeah,
they're going to
exactly.
close.
A
Did you make a
legitimate-
BlackRock meme?
no, hold on. A
Your
legitimate,
mom's calling. Dinner's ready.
A legitimate
Loser.
drag, if you want to make one, is that Fink was acting all holier than thou, and then pushing flows into their own
Well,
problem.
my thing is...
and like
if-
lecturing the E CEOs.
My thing is, if you're that wealthy and you have private jets and that's your choice of transportation and I don't know, are you really living an ESG life? Okay, fine, you have these funds, but like
You're definitely not.
there was a study that the top 0.01% are responsible for a good chunk of the carbon emissions.
Duncan's living that ESG life.
Crypto mining alone, you're killing the environment. And you're offsetting it a little bit with your ETF choice. It's hilarious. So back to Morgan Stanley, they brought in $438 billion of net new assets last year.
That's crazy.
A lot of that is taking directly from other people. I don't know who they're taking it from. The premise of the article is they found all these new funnels they have 15 million relationships with clients, every age of the age and wealth, every step along the spectrum in terms of age and wealth. They're unlocking value from E-Trade. They're probably converting a lot of the larger accounts at E-Trade into Morgan Stanley Wealth Management clients. They bought the stock plan administration business, which
Big.
deals with corporations and their employees. That's another funnel. And they seem to have, I think, come up with a better business model than whatever Goldman Sachs is trying to do in wealth management. What's your take from the outside looking in
Hang
on
on,
that?
Eric, before you get in, just look at this chart. 3 years. Morgan Stanley's crushing JP.
Yeah, I
I didn't realize this.
not sure why. We have a banking
100%
analyst.
versus 36. That's a big spread.
Yeah, I mean,
Over 5 years too. huh?
Everything you just described is, I think, the hustle you're going to have to do to survive, again, what I would call the Bogle effect. Everything is going to like 3 basis points. You've got to get creative. You've got to hustle, die for loose balls. That makes sense. Own the client. You've got to do all kinds of things just to avoid having your assets taken from you.
Well, there's now a
BlackRock and
willingness,
Vanguard.
right? There's now a willingness among the Wall Street banks to cater to everybody. There's no such thing as white shoe anymore. Goldman launching Marcus, acquiring gigantic RIA platforms and stuff.
United.
Morgan Stanley buying E-Trade. It's almost like we don't care how old you are. We have something for you. We don't care what level your portfolio balance is. We have a service that would work. That, like, to me, that's a really big change. That's really probably inspired by your, like, what your book is talking about. That is the Bogle effect on Wall Street.
Yeah, and one of the things I also thought was, like, you know, Vanguard came out in the 70s, and at that time, everything was commission-based and brokers.
Right.
In fact, I even called the section reform brokers because when you're talking about where the assets come from in Vanguard, the advisors, the reform brokers are the biggest growth area.
Yeah.
And I talk about, like, the fact that Vanguard may have had something to do with the RIA movement because you could not get their funds where you were. You had to leave.
Weren't they one of the first custodians for RIAs? And they didn't they didn't love it. They got out of the business.
I don't think so, but if they were, I didn't
know
get that
about
story.
that? Okay, it predates me being on the RIA side. All right, moving on. I want to ask you what. Here, I have some notes. From your book. Vanguard, the money that Vanguard raised over last year, let's say since the pandemic started, it like accelerated. And there was so much talk in the media about Robinhood, which is a big story. But really, the flows to Vanguard exploded higher. And it was silent. Like, we weren't even like, there weren't articles being written about it the way that there used to be.
Right.
They took in $80 billion year to date this year. The rest of the industry, $15 billion. So they're not
negative 15 billion.
negative $15 billion. Okay, so Vanguard is plus 80. The rest of the industry is negative 15. What's going on now? Is it just momentum carrying through?
Yeah, and you know, two things on that. One, you're right. They took in 300 and I think 30 billion last year. Now in 2014, 2015, they almost hit, or was 2016.
Let's pause on that number. That number is so big.
It's 1.5 billion a day.
That number for 1 year
day.
is so big.
I know.
It's unbelievable.
And there really wasn't much talk of it.
We've
because we're getting used to it.
We got desensitized.
How much
know.
does Robinhood have under management?
25, 40? I don't know.
40 billion?
I don't know.
And Vanguard took in 330 billion last year.
Yeah, no, Vanguard takes in like one ARC every month.
It's
It's
really astounding.
Yeah. And I think the theory on why Vanguard, the other thing is when the going is good and other people actually see inflows too, and their assets are going up because the market's going up, I think everybody just looks good. Vanguard's better, fine. But it's when a bear or flat market hits that I really try to stress here that their market share is going to explode because their relativity is going to be amazing because not only does the bull market subsidy stop lifting your assets and offsetting your outflows, it becomes a tax. And so your assets start going down and the outflows are hitting and you got panic boomers leaving your fund. Their market share will continue to grow. And why do people still invest in Vanguard in a bad market? That goes back to the early days, I think, where they forced people to come to them. So people were coming to them. They were astute. They were like, you know what? This makes sense. I'm going to go do this. And they are, I think, resigned that this is the best deal they can probably get.
Meaning they don't pay stockbrokers at Wells Fargo to sell Vanguard funds.
That's right.
So that's what you mean by come to them.
Yeah, they had to come to them. Bogle used Field of Dreams a lot. I guess he saw that movie in the 80s.
Iowa?
And he's, yeah.
I know it's just heaven. Oh, by the way.
Well, actually, Malvern is a little like Iowa. But anyway, he was like, build it and they will come. He was just like, look, let's make the best possible product and they'll beat a path to our door. But then there was a story Gus Sauter told me that I thought was also, I think, novel of the character and just or I don't know, discipline.
Gus Sauter's an early Vanguard executive.
Yeah, he was the CIO
Yeah.
for like 15 years when they launched ETFs. He knew Bogle very well. He knew Brennan very well. Anyway, he said that when he first got there, some big institution wanted to buy into one of the funds, but they were only going to be short term. And Bogle said no. And he thought, wow. And because there's good money or bad money. And so he, in the early years, only took good money, long-term money, and it was money that found them, that was very astute and knew what they wanted.
He had integrity about inflows.
Yes, so that core is why I think you see flows into their funds versus flows for other people tend to be market sentiment correlated.
So double time out. First of all, Vanguard, it's just a one-way flow. So they just always keep buying. But you've been saying this for a while, and you've been 100% right. Active managers have often said just wait till bear market. That's when we're going to outperform. That's when we're going to get flows. They have that
LOL.
exactly backwards.
Never
That should be their worst. That's their worst nightmare. If anything, they should be fine with the outflows because as long as the market goes up, it offsets it, and they can really extend the length of time they can sort of milk it.
So a lot of actively managed mutual funds, their assets have grown with the market, not because of flows. So when
absolutely.
the market falls, their assets
Listen to this
decline and the
stat.
flows come out.
Active equity mutual funds 10 years ago had $3 trillion. They've seen $2.6 trillion in outflows since then, but now they have almost $6 trillion in assets.
Jerome Powell. It's all Jerome Powell.
Yeah, I blame the Fed for that.
So the bond side a little better. Active bond funds have not seen the exodus, but they haven't seen a bear market.
Let's talk about bond funds.
Yeah.
Holy shit.
This year it's getting ugly. Bond funds could go through what equity just did.
The worst start for global bond funds since 1990.
So look at this. This is IEF. It's a 7 to 10 year treasury. By far the worst return.
We have that on screen.
By far the worst return going
he doesn't-
back to
he doesn't have to
inception
look.
of 2003. This is bad.
That's off the cliff.
So Eric, I've been saying that not only have bonds not been dampening the returns of the stock market or the declines, they've been causing it.
how come all,
Sure.
how come
Well,
all these funds that
This is the reverse Fed trade, right? It's the Fed put or the accommodative
In
policy
reverse.
in reverse, of course. So it all went
put
up
that
together.
chart back up?
It's probably going to all go down together for a little while. And bonds worse though.
How come all these funds that are leveraging bonds aren't blowing up yet?
Like the closed end funds.
Are we just not like
Talk into your mic.
the hedge funds? Why aren't they?
I think we'll see one.
Someone's
at some
gonna blow
point.
up,
yeah.
right?
Like
it's still early.
like the risk parity funds.
I hate saying that because then Jake's gonna go crazy on Twitter or something. But seriously, if you're like double and triple leverage treasuries, how have you not blown up yet?
Because
It's also a lot of exotic bonds. There was a few examples we used in the March 2020 sell-off. There was this one fund that came so close to having to just implode, and it had all kinds of weird, not just MBS, but just structured all kinds. Really out there stuff.
I only buy blue chip
But-
Russian convertible
but it was an
equities.
open-ended mutual fund.
Yeah.
And I would argue some of the active fixed income managers don't like those funds. I think some of the funds go pretty far out there, but I do think we'll see one at some point have to just halt redemptions or just say we're overextended. The only thing I would say about this sell-off is unlike March 2020 where 180 billion left bond funds in 2 weeks. That's insane. You have 100 billion this year leaving bond funds or 90 after 3 months. It's much more orderly. So as long as it's orderly, I think it can just bleed and then adapt later. It's just, will the downward spiral start to speed up where the more flows, the more they got to sell bonds in the market, which lowers the price of bonds, which means the return goes down and then people start to panic.
Yeah.
Well, that
If you're
downward
if you're a
spiral.
saver though,
I don't think so.
you're not being punished anymore.
So
You get 2.6% yield on 2-year money.
where do you
It's
think?
not bad.
Where do you think bond? So we've been talking about this on the show. Is it possible that money's coming out of bonds and into stocks? I don't think so. I think money comes out of bonds and goes into money market funds.
A little, because if you look at the outflows from active equity mutual funds, they're a little less severe than normal, which tells me there's probably some
Oh, you think?
rebalancing. Yeah, a little bit.
Oh, so it's rebound. Okay, that makes
A
sense.
little. But you can't just, it's rebalancing. Like some people on Twitter were like, oh, it's just rebalancing. No. The thing with bond mutual funds is if you look at their historical flows, they really
They're always
take
positive, right?
Right. Until rates go up and the market goes down. The taper tantrum 2018, March 2020. And every time they started to go down, the Fed came in and said something dovish.
It is kind of hilarious though, because you would think that as interest rates come up, money should come into bond funds because they're becoming more
Well,
attractive.
no, because yes, but all the funds own bonds worth less because you can get the new ones at higher rates.
Okay.
That's the problem. All these funds own bonds that are just not worth as much as they were last year.
It's a portfolio that's already down versus newly issued.
Yeah, but
bonds
And
that
the
with
more
higher
rates go
yields.
up, the more you can get more high yield. So, and yes, they can. That's why, in my first book, you had a great quote. You said, how do you deal with rising rates? You're like, you did it the way your grandpappy did it. Or I forget.
Yeah.
You ladder.
Yeah.
Laddering really, if the fund ladders, I suppose that ultimately they will be able to do what you say.
Well-
But at the time, I guess all their bonds are the ones
But that
worth
doesn't.
less.
But that doesn't explain investor flows because I'm saying money should come in as rates rise. It shouldn't leave.
The explanation.
Well, no,
for,
it's the reason the money's leaving is because the returns are down. Like if you
Right.
look at
No, I
if you look at
understand.
double
Yeah,
line,
totally.
Listen, a negative monthly performance
in bonds.
that just triggers people.
I get it. People,
Yeah.
but people are afraid that, oh shit, I lost money in bonds. And people are having all sorts of crazy reactions
Yeah.
because they've never seen this before.
That's right.
And they think it's going to get worse, which I understand. But no, it's actually going to get better.
Yeah, I mean, what are they waiting for? They can pull out now and then just wait till what? There's a positive return? Maybe, I don't know. But I just know that bond flows tend to be correlated with the red or green. You know, if they're green, they see money.
So, bond ETFs, are they heavily used by hedge funds and institutions as trading vehicles?
Yes.
So doesn't that partly explain, like if you have that as your risk off piece and it's down 4%, you're like, we're getting out of this. We're shortening up duration, or we're going into cash or something.
Well, you bring up a good point. A lot of mutual funds institutions use HYG, TLT,
JNK.
LQD. And they use it.
They're not buying 800 bonds. They're just buying the index.
Well, no, they buy the ETF as a moat around the bonds.
Yeah.
To cash people in and out. So it's like a cash, it's almost like holding cash, but you actually get beta to the market. That way you don't have cash drag. Although cash drag would help now. So I think a lot of them did buy these ETFs as moats to get beta. So if somebody got out of your fund, you could sell it. We see this because when there's bond mutual fund outflows, the ETFs start to trade at discounts a little bit.
I guess I hadn't
because that's the
realized
first
that.
thing they sell before they go to the bonds. They got to eat through the ETFs.
It's easier to sell the ETFs than
Totally.
to start calling bond brokers, bond dealers.
Yes.
Okay, got it.
So we've got the Fed, $95 billion of liquidity coming out of the market, or that won't be continually going into the market. And there are starting to see some cracks in the stock market. Like the Russell 2000 looks like shit. Home builders look like shit. Transports are crashing. And yet, the index for now is like sort of still hanging in there a little bit.
What do you mean, the S&P?
The S&P and the NASDAQ.
The S&P
Particularly the S&P.
isn't the S&P like pretty resilient? I'm impressed at how well it's held up after all. It would say 4% off its all-time highs
can't
after
believe
all
it.
this.
No, it's...
It should be so much worse.
I mean, what, 6%?
Is that all it is? Oh
If
my
stocks
God.
really correlated to headlines, we would be in a 20%
The
bear
S&P
market.
is just the baller. That's why it's the king. I mean, it's
crazy.
You know, it just you get tempted by the cues, but at the end of the day, that index is something
Eric,
special about it.
VGK outflows are going into the S&P. I'm absolutely convinced.
Europe, right,
Europe
bro?
is guaranteed a recession. Okay, they're getting almost a third or more, depending on who you ask, of their oil and gas from somebody that's actively like thinking about bombing them.
By the way, also the S&P, you know how people are like, oh, it's just large caps, and also these like 10 mega caps, it's all weighted by like these 10 companies. Sam Rowe had this great point, which changed my perspective of the S&P, which is that those 10 companies are like 12 companies each. It's like 120 companies.
Google's like 70 companies.
Yeah. If you look at it that way, it's very diversified. And that's I think part of why it's so strong.
You sound super complacent. That's the last thing someone says before the bottom falls out.
But here, by the way, speaking of the bottom falling out and index funds, I would ask you guys this. I think if I were to talk to you guys about, like, let's say you held VTI in your personal account, is there anything that would get you to sell?
No.
Right, because
My daughter's wedding.
Right, that's the lifestyle. I'm talking
Yeah.
in the market. Is that because you're resigned to the fact that there's nothing better you could do? What are you going to jump into?
Don't have time to try to do something
My
better.
default setting is the market will be higher 10 years from now. That's
Yeah.
always my default setting. So I don't give a shit if it gets cut in half or worse. I'll be buying.
This is why passive will remain strong in bear
Yes.
markets. A lot of the people who are like, "Oh, it's going to bring the market down," and I have a section of this in the book too. Weak hands is what they call it. I'm like, no, these are the strong hands. These are people who rarely sell. I think the next correction will be money coming out of active because they're older boomers who were put there by their broker. So there's less loyalty, and they're older. They don't want to like lose the money, and I think that's going to be where the stress comes from. Passive will actually probably be a bid. In the next, even if the bear market's 4 or 5 years. But then I was on the Resolve podcast, and those guys are like, yeah, but what if these index funders have to eat shit every day for 6 years? At some point, they will capitulate. I'm
No,
like,
it doesn't
I don't
work
know.
that way
No.
because the buyers are dollar cost averaging. They don't give a shit. They don't even know.
Now, what about alts? Like, say you have 60-40 and like it all went up together. Now it's going to go down. Do you guys consider like adding an alt or something that like maybe could go up and sort of offset you a little?
Do we consider it?
Yeah.
We do it.
Yeah.
Yeah, we do that already.
And what do you use in that alt bucket?
we have our own strategy.
So
but
I
What's
think
it called?
we're not allowed to promote.
I think
okay.
one of
Is it like does it have a short
You
component?
see my wink? No, we don't short.
Eric,
we don't
I
short
think-
anything.
How is it alt though?
because
because it's trend following.
Okay.
One of-
I see. Okay.
one of the problems, and I'm casting a wide net, so nobody take offense to this because there's obviously great solutions out there. Generally speaking, one of the problems with strategies that try to limit the downside is they can't survive the upside. And for that reason, like CTAs, for example, or managed futures, like They're doing great this year, by the way, I think. But they've been horrible for a decade. And that's just really, unless you are a dyed-in-the-wool quant and you totally get it, even then. But to put that into a client account that can be dead money for 10 years while the S&P triples is just really hard.
That's why my proprietary timing system enables me to know when to put the alt on. So I'm actually timing the market timing.
So Eric, not only will I never sell, but
Genius
I
brain.
will, to plug another book, I will just keep buying. How about that?
Nice, very nice way to work. That was very subtle.
Last thing on Bogle before we move away from that. Two things. I think you wrote this. Vanguard's move into advisory business will send them into many un-Boglean places for better or worse. Jack would not want to see
Wait, how do you spell
Vanguard.
un-Boglean?
I don't know. This guy wrote it.
I wrote it in the notes.
It works, but it
UN
works.
hyphen.
Oh, that's hilarious.
Yeah.
Un-Boglean places. Duncan, write that down. What do
I
you mean
use
by,
his name and I have Bogleosophy in there. I got Bogle metrics.
what do you mean by
Just to entertain myself.
Wait, so the rise of index, was that a Boglesons?
The what?
A Boglesons.
Yeah.
there was a Bogle sense?
So what do I mean by that?
Why is it un-Boglean to give financial advice?
Yeah, I think he just didn't want that much. Or that's a general thing. He didn't like them being so big. That's but if Vanguard investors got older, and I think the natural thing is to have wealth management to help them now that they're wealthy. And so they launched this business. It's only 90% Vanguard clients. Oh, that's a big pool to draw from. But that business, if you want to be up there with a major full-service advisor, wealth manager for very wealthy people, you got to have private equity. You got to have a direct indexing, SMAs. You got to have. You
need
might even have to have
talent, too.
crypto.
You got to pay up for advisors, or they're going to leave.
Well,
But they have
by the way,
tons
listen to this.
they have so many advisors.
They have over 1,000 advisors, CFPs.
Yeah. They have
In
more
fact,
CPs than
I-
anyone.
Aaron-
But they're under 40.
They might. I mean, they probably have some like system where they
Well,
can just.
that's the thing, though.
Yeah.
So then they're competing with Schwab and Fidelity's
Yeah, probably.
branch system.
Yeah.
Which
So there's
tough-
a
tough
whole
to compete
section in
with.
there on where advisory is going, and Kitsis was probably the great guy to ask about this, and he sort of said, look, there's probably half the business is really brokers who aren't like CFPs. They're probably going to get Vanguarded, but if you're doing niche work, you're local, or you do high touch, or you have something special, those will be the survivors.
Vanguard's not trying to build that.
No,
in-house.
they're going
No.
after that like very vulnerable, like
What's the
disruptible
new
middle.
What's the new CEO's name again?
Mortimer.
No.
Tim.
Buckley.
No, literally, Tim Mortimer.
Buckley.
Buckley.
So Buckley said publicly when he came in as CEO, he said,
I'm coming for you.
No, we are going to do to the advice business what we did to the asset management business. And they are working on it like every day.
Yeah.
So
And they're swamped.
where the
too.
margin is.
Yeah, they're not alone, but although I am.
doesn't mean they'll succeed, but
Right.
that's what they're doing.
Yes, and that's where I think they're got a partnership with a private equity firm. I think ultimately Vanguard, if they're going to try to have all these things available to their clients, at some point they could say, "You want crypto? Get out of here, or go get it yourself." But
Get outta here.
I think at some point they're going to have all these things, and I just know Vanguard. They're going to go and look at the marketplace and go, "This is all high cost shit." We're going to have to either work with a partner who will lower their fees for us in a partnership, or do it ourselves.
You know what's un-Boglean? NFTs. Very un-Boglean.
You said that Bogle and Vanguard are arguably
You
more.
mentioned Bogle on NFTs. I would love to see a Barron's reporter asking Bogle about ape NFTs.
Oh, he'd throw his cane at him. You said Bogle Vanguard arguably more DeFi than much of DeFi. What do you mean by that?
So you know how crypto and DeFi are all we're
Disrupting.
we're
and-
disrupting, we're over here. It's like minting billionaires right and left. The fees they charge are really high. The intermediaries are really making a killing selling
They make up
populism.
for it by how convenient it is, though. LOL.
Yeah, I mean, that's something where I think Vanguard took. If you go into an index fund and you buy and hold it, Wall Street gets none of that money. It's basically taking it out of the casino completely. It starves the machine. And I don't know if crypto's starving the machine. I think they're turning into the machine to some degree.
They're feeding the machine.
They,
it's the most profitable
they even
business
had put a
there is.
bull in front of the crypto exchange that looks like the Wall Street bull. I thought that was weird. Aren't you supposed to be fighting? They're slowly, and then you ever see when
Where's the
In
crypto
Miami.
exchange?
Miami.
At the Bitcoin
yeah,
conference.
they put it bull, but it has laser eyes. And it's like, anyway, but
Gross. Crash, please.
did you notice that when Morgan Stanley or Goldman Sachs says, "Oh, we're like either we're bullish crypto in a note," or they start saying we're going to trade it or service our, the crypto crowd really likes that. I feel as though there's a tension between their message of populism and like anti.
They love disruption, but the only thing they love more is when the New York Stock Exchange and Goldman Sachs get involved. Then they get really excited.
I agree.
So they don't care about disruption. They want higher prices for their coins.
Yes, and so I think even though Vanguard is part of the system and is an asset manager, it's pretty DeFi'd. I mean, the ethos especially.
It's the original DeFi.
And it's true like vegetable type DeFi. There's nothing funky going on.
How about just the radical act of building that in the middle of nowhere, Pennsylvania? They didn't build it in Philadelphia. They didn't build it in New York, Boston, Chicago. Like that in and of itself, and Schwab did that too. They went to San Francisco. Like they started as outsiders. That was like the original DeFi. I totally agree with you. Active managers in Q1, we alluded to this earlier. ESG was not anyone's friend. We have John, throw this up. So the dark blue is the S&P index return. The light blue is the average fund return. And that yellow diamond is the percent beating the index.
Dude, why is it getting harder? Just keeps getting harder.
All right, only 8%, only 8% of core large cap funds beat the index in the month of March. And where are
You know
we
the
for
Ron Burgundy gif? I'm not even mad. I'm impressed. Like how?
Where are we for the 22% of all funds are beating the S&P 500 in the first quarter?
You know
it's getting
why?
harder.
Nobody knows the future. You just can't get around that fact. Who would have thought that oil would be kicking ass after people pronounced it dead?
This is Savita Subramanian at Bank of America. What hurt in first quarter? Not owning energy. One of the main culprits of active's underperformance in first quarter was their ESG-friendly portfolios. Active funds were 27% underweight energy in Q1, where it was the best quarter for energy since 1970. 44 percentage points versus the S&P 500.
And you know what? Not their fault. I mean, I don't blame them.
Their underweight in energy itself detracted about 33 basis points of alpha year to date. So what do they do now? Go chase oil stocks? Is that the right response?
This is inherently why a lot of people have dropped out and gone indexing. They think, well, maybe they catch a right call, but then the next call is off. And what are you going to do?
It's too hard.
It's so hard. It's just hard. I mean, anybody who's tried to do it on their own knows how hard it is to get every timing and call right.
But to Michael's point, it almost feels like we should have had this shift at some point where it got easier again. It's getting worse.
Yeah, because a lot of people were like, well, all the retail left to go indexing. Now the people left the poker table are like the real smart people with all the computers. But then Robinhood came in, and you'd think they were easy. But then like they actually did pretty well. They were really risk on, and some of them did pretty well. And then actually those pros started following the Robinhood crowd and sort of like trying to ride that momentum that they had. But I just think it's ultimately the not knowing the future is just...
It's insurmountable.
What can you do?
What can you do? Or not being able to do that reliably is the whole thing.
Yeah, I talked to Barry once, and I was like, Barry,
How many hours deep?
Barry's the only guy we had to do double episode of our podcast. We called it Use Your Disillusion 1 and Use Your Disillusion 2.
He had more material than one episode could hold.
Yeah, we had to break it up into two. That was the one time where we actually broke the rule of the 52 episodes. We had 53 that year.
I once heard Barry on the phone with a reporter. It was on speakerphone. Barry used to take all his calls on speaker, which was a pleasure for me when we were sitting offices next to each other. I actually heard the reporter be like, all right, Barry, I got to go. I've never heard a reporter try to get off the phone before with a source in my entire existence on Wall Street.
He is very fascinating. That was one of our best downloaded episodes, though. People like to... My mom loved it.
We love Barry.
My mom was like, this guy is really interesting.
You know what? He doesn't phone it in. If you have him on your show, he gives you all of it.
And he instead of saying a response, he'd be like, Alex, I'll take cognitive bias for $100. That's the way he kind of will get into an answer, and it's fun.
Yes. Fun for sure.
He's been described as a golden retriever, like a person. Like he loves people and he loves talking.
Yeah, no, he's
That's
great.
why. But that's why the audience loves him because he gives you the full Barry.
All right, let's talk about stock splits.
What's going on here? Put this up.
All right, so this comes from Lindsay Bell. She's a chief market and money strategist for Ally. So stock splits have basically gone away, and I think I was over indexed to how many stock splits there were, just given the big ones that we've seen over the years. We saw Apple did Amazon split, right? Amazon split, Tesla
announced split.
So there really haven't been that many, and this surprised me. So there's an index that they have it's called the 2-for-1 index, which is from S&P Capital, showing the S&P versus the 2-for-1 index. I would have thought that the stock split index, because you see like these stocks pump on these news and you're like, well, this is the dumbest thing ever. Actually, if you were to systematically invest in these companies, they haven't outperformed. Haven't gotten killed.
And
but
how would you do that? Because you're going to buy them after they gap.
I don't know the methodology.
That's the problem,
That's
though.
the
They
thing.
announce a split after
It's like
the close.
M&A or something.
So you're going to pay up 6% the next morning, or in Tesla's case, up 20%. Probably not the best.
They will try an ETF for this though.
Totally.
What, a stock split ETF?
Yeah, you'll
I bet
see.
you
I
there is
think.
one.
What do you think?
There might have been one, but I forget. Somebody, the guy who did the uranium miners tried a stock split or something like that. I got to look, but
That's
it was
crazy.
Why do we
stupid,
think- why do we- what-
stock split in ETF?
Listen, if something's working and there's some news coverage or they'll try it.
Why do we think that stocks go up on the announcement? Is it because that there's more potential dollars coming in from
I think so.
smaller investors?
Because
Yeah.
people
Yeah.
think that other people are going to buy it.
But
once it
that
splits.
might actually be a thing.
It is a
Yeah,
thing.
yeah.
It's actually not a money loser.
Yeah.
If you did that, A, everyone smart would laugh at you, and B, you made money.
Yeah.
So it's one of those things that shouldn't work but continues to work. What are we doing here about Tiger Global?
I don't really have much to say about them. I mean, Eric, you have anything to say about Tiger? They basically they Kings on the way up and killed on the way down.
hard.
Down
hard.
38% since December 2020.
Yeah, it's-
versus Nasdaq up 16%.
So I think JD.com was their biggest holding. I think that was it. They were in early, so they made 47x on the way up. And when this thing gave back, it's their biggest holding. Okay.
Did anybody
It's a little
do,
arky in yeah. I mean,
Did anyone do the meme with Winnie the Pooh where it's like Ark wearing a T-shirt and then under it
Tiger Global.
Tiger Global with
Yes.
the
That's
with the
bad.
monocle?
That's not bad.
It's
yeah,
not bad.
yeah, it's not bad. But by the way, John Bogle Jr. was telling me that he was an active manager and he would talk to his dad, Bogle, about being active, and Bogle would just be like, "It's a hard business."
How old is
It's
John
hard.
Bogle Jr. now?
I want to say 55-ish.
How old is the third?
Like his kids. I don't know. I don't know if there's a John
Wait,
Bogle.
are you telling me John
the
Bogle
third.
Jr. is a Gen X? Can we claim him? Is he one of us?
55?
Is he into Stone Temple Pilots?
I talked
Get him
to
on the phone.
If he's Gen X, he's pretty mature.
Okay.
I thought he was.
He's an older X. He's
Yeah.
like Barry.
He's a
Yeah.
geriatric X.
Barry's an older X.
Yeah, I think he's like Barry's age. That's
Born
my
in
guess.
the mid '60s is
Yeah.
an older X. They were really into Caddyshack, that part of our generation.
Yeah.
And,
Actually,
and Stripes. They think Stripes is
Barry
Yeah.
Creative
Lawrence of
comedy.
Arabia.
Barry just got me the book on the making of Caddyshack. I'm like, why did you buy this for me?
for you. What are you supposed to do with that?
But that's the same publisher or the literary agent I have. That he made that book.
Oh yeah.
Yeah, I haven't read it yet. I got it. I was at his office and I said, "Oh, that looks cool." He's like, "Oh, you can have it." Is it good? Have you read it?
This is going to be an unpopular take with the older Xers. It does not age well.
What?
Caddyshack.
I rewatched it recently. It's not
just
funny.
not that funny.
It's not that funny.
Dangerfield is the only good thing.
Rodney Dangerfield did Somebody Step on a Duck, killed me. That was the first belly laugh I ever had in my entire life. I was like 6 years old.
I know,
But it's not that funny.
Something about Ted Knight being frustrated is pretty good. He's so good at being frustrated. It feels good.
It's not enough. It's not
Okay,
enough.
I don't know. I haven't seen it in a while.
But listen,
though.
I'm just telling you that if you saw it today for the first time with a clean slate, you'd be like, I don't get it.
I don't get it. What's the big deal?
Yeah.
We did this bond chart already. I think we're into favorites, guys.
By the way, Eric, that doesn't take anything away from the movie. For example, I recently saw Top Gun for the first time.
Really?
And if I saw Top Gun when I was 8 years old, it would be the best movie ever. Unfortunately, I saw it when I was 35 years old. And it's just, sort of
Well, okay. Out of 5 stars, what would you give it?
I appreciate the fact that it meant a lot to
7
people at the
stars.
time.
You can unwind that as
Yeah.
a person watching it. Like let's say it just came out and you had to rate it.
But it wouldn't come out today because it's so 80s.
You're right. They're up in each other's faces going, who's the best of the best? It's all just sort of 80s.
Very Cold War, like
alpha male.
Rocky IV.
Yeah,
Literally.
Everybody's sweating
Dude,
and
it's
glistening.
a time capsule. It's a time capsule. They're playing volleyball on the beach with lathered up in jean shorts.
They definitely are. So everything's lathered. Like Rocky got lathered. A lot of lathering in the 80s.
We're gonna lather you next time. Lather you next time. We're gonna build you a Bond lather. The best Tom Cruise movie is Cocktail.
I recently saw that.
I want to get your reaction.
Cocktail's
to that
better.
Is that the best? Is that peak TC?
The fact that he could make a movie about a bartender that good and make it $100 million, I think it's probably
one of the best movies
his best
of the
accomplishment.
80s. It's one
I don't
of
know
the
if
best
it's best
80s
movie.
Hang on. Best Tom Cruise is A Few Good Men.
It's not his movie though. It's Jack's movie.
No, it's not.
Anybody could have played his part.
Jack's in it for 11 minutes.
Anybody could have been Tom Cruise in that movie. Any actor could have played the role of the lawyer. Jack makes the movie. There's no movie without Jack. I'm just telling you, that's like the calculus of that movie. You could have switched out every character. That to me is not a classic Tom. You can't make Cocktail without Tom Cruise.
Correct.
Can't make Top Gun without Tom Cruise.
What about Tropic Thunder?
That's a good part for
Les
him.
Goodman? Is that his name?
Oh, that's one of my favorite TC performances.
Yeah,
I wouldn't call it a Tom Cruise movie, but
No, of course not.
that is as good as he gets, I would say. You want to
What
share
else
any
is he
thoughts
in?
about Tom Cruise? Is Tom Cruise in the Bogle effect?
I'm trying to. I have a lot of. I have a
plays
good chunk
Bogle?
of pop culture
Who plays
references.
Bogle? Who plays Bogle?
I don't say. Well, there is no actor. That said, I do reference that he did look like latter-day Henry Fonda. Whenever I saw him speak, he always looked like on Golden Pond era.
I only saw him once.
Henry Fonda.
Real life.
I know who plays him. He's dead though. James Cromwell.
James Cromwell is not dead.
He's not dead?
Spread rumors on this podcast.
I'm sorry, he's
Wrong
alive.
with you. He saw
sorry.
a movie yesterday.
I'm sorry.
All right, I think we're gonna.
Somebody on Twitter the other day said when a Gabelli put an ETF out that tracks like automation, it's 95 basis points, and someone's like, if Mario saw this, he'd be rolling over in his grave.
And he's alive.
Mario's on Twitter. Sorry,
He's
James
on
Cromwell.
Twitter.
He'd be rolling his grave because it's not 150 basis points. He wouldn't like that 95 stuff.